Today, we're diving into the essential basics of the closing process in real estate. This is the moment when all the hard work pays off and you finalize the purchase of your new home. We'll break down the key documents involved so you know exactly what you're signing and why it's important. This guide is designed to make the paperwork clear and straightforward, helping you feel confident every step of the way. At closing, several important steps happen to finalize the purchase. First, all the necessary documents are signed by the buyer, seller, and lender. This includes the final legal paperwork and loan agreements. Next, funds are collected, which means the closing costs, down payment, and any lender funds are verified and disbursed appropriately. Finally, ownership transfers when the deed is officially recorded, making the buyer the new legal owner of the property. This marks the final step in completing the purchase process. Let's talk about the purchase agreement, which is really the core contract in any real estate transaction. This document spells out all the key details of the sale, like the price, any contingencies that must be met, important deadlines, and what items or fixtures will remain with the property after the sale. Both the buyer and seller sign this agreement before closing, making it a binding commitment. Essentially, the purchase agreement serves as the legal roadmap for the entire closing process, guiding every step that follows to ensure both parties fulfill their obligations. Understanding this document is crucial because it sets the foundation for a smooth and successful closing. A deed is the key legal document that officially transfers ownership from the seller to the buyer. It's signed at closing and then recorded with the county, which makes the change of ownership a matter of public record. The deed includes important details like the identities of the parties involved and a legal description of the property. This helps ensure there's a clear, verifiable record of who owns the home. Without a properly executed and recorded deed, the transfer isn't fully recognized in the public records, which could cause complications down the line. So, the deed is really the core document that formalizes a change in ownership. Now, let's talk about the key financing paperwork involved in a loan. First, there's the core promise, which is a promissory note. This is the borrower's legal commitment to repay the loan. It outlines important details like the loan amount, the interest rate payment schedule, and what happens if the borrower defaults. Next, the security instrument, which can be a mortgage or a deed of trust. This document pledges the home as collateral for the loan, giving the lender the right to enforce repayment by taking the property if payments aren't made. Then we have the loan terms, detailed in the truth in lending statement. This disclosure highlights key borrowing terms such as the annual percentage rate, or APR, finance charges, the amount financed, and the overall cost of the loan over time. Finally, the closing disclosure presents the final numbers. It summarizes the loan details like projected monthly payments, the cash needed to close, and all associated closing costs before the documents are signed. Together, these four documents define the loan, secure the property, and clearly outline what the borrower will pay throughout the life of the loan. Understanding these documents is crucial for anyone taking on a mortgage. Now, let's take a closer look at the key loan documents, starting with the sample loan form. At the heart of this form are the core fields: loan amount, interest rate, and payment term. These are essential details that define the basics of the loan agreement. One of the critical documents here is the promissory note. This is the borrower's formal promise to repay the loan. Essentially, by signing this note, the borrower acknowledges their commitment to pay back what they borrowed. This note also clearly outlines the loan amount, the payment schedule, and importantly, what happens if payments are missed. It sets the expectations right from the beginning. Regarding the interest rate, the note defines whether the rate is fixed or variable. This locks in the agreement on how interest will be calculated over the repayment period, providing clarity and avoiding surprises later on. Overall, these documents work together to ensure both parties understand and agree to the terms of the loan. On this slide, we're looking at the two main types of security instruments used in real estate lending: the mortgage and the deed of trust. Both are designed to secure the loan, but they differ in their structure and how foreclosure is handled. First, the mortgage follows what's called the two-party model, involving just the borrower and the lender. When a mortgage is in place, it creates a lien on the property. If the borrower defaults, foreclosure generally has to go through the court system, making it a judicial foreclosure process. This model is common in states that require judicial oversight during foreclosure. On the other hand, the deed of trust uses a three-party model. Here, we have the borrower, the lender, and a trustee. The trustee holds a legal title to the property as security for the loan. One key difference is that foreclosure under a deed of trust often happens outside of court, known as non-judicial foreclosure, which can speed up the process. Despite these procedural differences, the end result is similar. The lender holds collateral until a loan is fully repaid. Understanding these instruments helps clarify how real estate loans are protected and the mechanisms available if the borrower defaults. Here we have the key disclosure items required by law when you take out a loan. First is the APR, or annual percentage rate, which represents the total yearly cost of borrowing. This includes interest as well as other fees, giving you a clear picture of what you'll pay over a year. Next, the finance charge reflects the total dollar cost of credit, combining interest and certain fees. It's important to understand this number because it shows the actual cost of the loan beyond just the monthly payments. The payment schedule tells you how much you'll pay, how often those payments are due, and the total number of payments required. This helps with budgeting and planning your finances over the loan's term. Additionally, some refinance and home equity loans come with a right to cancel. This means you have a 3 business day period during which you can reconsider and cancel the loan without penalty. All these disclosures are part of the Truth in Lending Act, or TILA, which ensures that the cost of borrowing is transparent before you sign any agreement. The goal of TILA is to make loan terms easier to compare and understand, helping you avoid surprises and make informed decisions. Now, let's talk about the closing disclosure, which is your final cost summary before you sign any documents. This document is really important because it lays out all the key loan terms, including your monthly payment, the cash you need to bring to closing, and the closing costs involved. It's essential to review this carefully to make sure that all the numbers match what you were expecting. If you notice any differences in fees, rates, or credits, don't hesitate to ask questions before you sign. Typically, you should receive the standardized final disclosure at least 3 business days before closing, giving you time to thoroughly check every figure and feel confident about the agreement. Always double check everything because this is the last step before finalizing your loan. When we talk about title protection, due diligence is absolutely essential. The core check here is making sure the seller actually has clear ownership that they can legally transfer to the buyer. This is where a title report and title insurance come into play. The title report gives us a detailed review of the property's legal history before the sale is finalized. It reveals any ownership history, easements, restrictions, liens, or other title defects that could impact the property. Knowing this information up front helps avoid any surprises later on. Title insurance, on the other hand, provides protection against ownership issues that might come up after closing. It safeguards both the buyer and the lender from hidden claims, unpaid liens, or recording errors that weren't identified before the sale. Ultimately, this process is crucial because it ensures that the buyers get what they pay for a clear, marketable title, and reduces the risk of costly disputes or legal challenges down the line. Let's talk about escrow and how it works to keep funds and documents secure during a transaction. Escrow involves a neutral third party who holds money and paperwork safely until all the agreed conditions have been met. First, the buyer wires the closing funds, and the lender sends the loan proceeds into escrow. This ensures that all the money needed for the transaction is in one secure place. Next, escrow verifies all the important documents. This includes checking signatures, ensuring the title items are correct, and confirming that lender instructions are complete. Then, any remaining conditions must be fulfilled. This could involve clearing insurance requirements, paying off any existing loans, or getting necessary approvals. Only when all these conditions are satisfied can the process move forward. Finally, escrow releases the funds, disburses payments, records the transfer of ownership, and officially closes the transaction. This step completes the process, ensuring everything is handled fairly and securely for all parties involved. When it comes to closing costs, buyers typically can expect to pay between 2% to 5% of the purchase price. This range depends on several factors, including the lender you work with, the location of the property, and the specific details of the transaction. Let's break down some of the common line items you might encounter. Lender fees usually fall between 0.5% to 1% of the purchase price. Title insurance costs can vary quite a bit, depending on the policy and provider. Appraisals tend to cost somewhere from $400 to $800. Inspections are generally around $300 to $700, while attorney or settlement fees could range from $500 up to $1,500. You'll also see recording fees, which are typically between $100 and $300. Prepaid taxes and insurance amounts will vary based on your local tax rates and your insurance plan. Escrow funding usually covers 2 to 6 months of payments, which helps protect both you and the lender. It's very important to carefully review the closing disclosure statement you receive before closing, as it will provide the final, exact numbers. And don't forget to ask about any seller credits that might be available to help offset some of these costs. Understanding these key components will give you a clearer picture of what to expect when closing on your new home. As we prepare for closing day, it's important to bring a few essential items to ensure everything goes smoothly. First, you'll need a government-issued ID. This could be your driver's license, passport, or any valid photo identification. Next, make sure to have your cashier's check or wire confirmation ready for the down payment, closing costs, and any remaining balance due. If requested, bring proof of funds, such as transfer receipts or bank documentation. Don't forget your homeowner's insurance details, including the policy declarations page and your agent's contact information. Lastly, bring any paperwork that's been requested, like the closing disclosure, purchase contract, or lender instructions. Having all these items on hand helps make closing day efficient and hassle-free. Before you sign the final papers, it's crucial to do a thorough walkthrough and inspection of the home. This is your last opportunity to make sure property is exactly as agreed upon. Start by verifying that any repairs promised have been completed. Compare receipts and repair requests with what's actually been done. Next, test all the systems. Check the lights, outlets, plumbing, appliances, HVAC, and even garage access to ensure everything is working properly. Finally, confirm the move-out condition. Make sure the home is vacant, unless you agreed otherwise, and look for any new damage or issues that may have appeared after the seller moved out. Taking these steps helps avoid surprises and ensures you're fully satisfied before finalizing the sale. Now that the signing is complete, there are a few important steps to wrap up the process and get everything officially in your name. First, the county records a deed, which means your ownership is now part of the public record. This step is crucial because it makes your property rights official and legally recognized. Next, once the recording and funding are confirmed, you'll typically receive the keys, any access codes, and other details you need to move in. This is the moment you really take possession of your new home. After that, don't forget to transfer the utilities like electricity, water, gas, and internet into your name. This ensures that all services continue without interruption and are billed correctly going forward. Finally, prepare for your first mortgage payment. Your lender will provide you with instructions on when it's due and where to send it, so keep an eye out for that communication. As a best practice, keep your recorded deed, title policy, and entire closing packet organized in a safe place. You'll need these documents for future reference, whether it's for taxes, refinancing, or if you decide to sell the property later on. These post-closing steps are key to making sure your transition into homeownership is smooth and secure. As we wrap up, let's focus on the key documents involved in the closing process and why they're important. First, the purchase agreement. This sets the deal terms, including the price, dates, and any contingencies. It's the foundation of the transaction. Next is the deed, which legally transfers ownership from the seller to you, the buyer. Then there's a promissory note, which is your written promise to repay the mortgage loan. The mortgage or deed of trust pledges the property as collateral for that loan. The closing disclosure is essential as it shows the final loan terms, the cash you need to bring to closing, and all the closing costs. Your responsibility as a buyer is to carefully review and fully understand every document before signing. Remember, each of these documents has a specific legal purpose, so taking the time to understand them will make the closing process smoother and protect your interests.